Real estate always wins. You've heard that your whole life, right? Your uncle said it, that podcast said it, that guy at the office who bought a duplex in 2019 definitely said it. And here's the thing, he's not lying to you. Real estate can win, it genuinely can, but there's a version of that sentence that nobody finishes out loud. Real estate always wins, if you do it right, if you pick the right market, if you get decent tenants, if nothing major breaks in year 3, and if you actually account for every dollar going out, not just every dollar coming in. That last part, accounting for every dollar going out, that's where the whole conversation falls apart. Because most people who swear by rental property have never actually sat down and calculated their real return. They count the rent check. They don't count everything that comes out of it before they keep any of it. Today we're going to count everything, both sides, real estate and index funds, 20 years of actual math. And at the end, I think you're going to see this whole debate differently. Meet Tyler and Marcus, same age, both 28, both living in the same mid-size American city, let's say Columbus, Ohio. Not a crazy hot market, not a dead one, a real, normal American housing market. Both just saved up $50,000 after 3 years of disciplined living. Same income, $65,000 a year, same starting point. One decision separates them. Tyler goes to a real estate agent. He puts that $50,000 down as a 20% down payment on a $250,000 single-family rental home. 3 bedrooms, decent neighborhood, good school district. Gets a 30-year mortgage at 7% interest. Finds a tenant. Starts collecting rent. Marcus opens a Fidelity account. Drops the same $50,000 into a total stock market index fund, something like VTI. Sets up an automatic $400 monthly contribution. Goes back to his life. Tyler has a set of keys and a lease agreement. Marcus has a confirmation email and a portfolio dashboard. On day 1, it's not even close in terms of how it feels. Tyler is a homeowner, a landlord, a real estate investor. Marcus has a brokerage account nobody asks about. But we're not here to talk about feelings. We're here to talk about what actually happens over the next 20 years, including the parts that make your stomach drop. Tyler's monthly mortgage payment is $1,663. His tenant pays $2,100 a month in rent. On paper, that's $437 a month in profit. He texts his friends. His friends are impressed. But then reality starts knocking. Month 4, the water heater dies, $1,200 gone. Year 2, 1 month vacancy between tenants. That's $2,100 in lost rental income, plus $800 for cleaning, repainting, and relisting on Zillow. Another month of mortgage still due with 0 rent coming in. Year 2 also, property tax bill arrives. In Columbus, that's roughly $3,000 to $3,500 a year on a $250,000 home. Homeowner's insurance adds another $1,400 annually. And then there's the thing nobody tells you when they hand you the keys. Being a landlord is a part-time job you didn't apply for. Tenant calls at 10 p.m. because the furnace is making a noise. You spend your Saturday morning on the phone with an HVAC company. You spend your lunch break reviewing Ohio landlord-tenant law because your tenant is disputing the security deposit. You drive across town on a Tuesday evening to handle a noise complaint from the neighbors. After all real costs across the first 3 years, mortgage interest, vacancy, repairs, property taxes, insurance, maintenance, Tyler's actual net cash in hand is somewhere between $3,000 and $6,000. Not per year. Total. Over 3 years. That $437 a month profit, it doesn't survive contact with reality. Marcus put in his $50,000. He set up $400 a month automatic contributions. He went back to work. Year 1. His portfolio is up around 10%. Nothing dramatic. Year 2. The market pulls back 12%. He gets nervous. He checks his account more than he should. He doesn't sell. Year 3, it recovers and pushes higher. His coworkers don't ask him about his investments at lunch. There's nothing exciting to say. But by the end of year 3, his portfolio is sitting at around $76,000 to $82,000. He spent 0 hours managing it. 0 emergencies. 0 late-night phone calls about a broken furnace. This is where real estate investors push back. And they're right to, because something real is happening on Tyler's side. The leverage argument. Tyler used $50,000 to control a $250,000 asset. That's a 5-to-1 leverage ratio. As the property appreciates, let's say 4% a year, which is reasonable for a stable Midwestern market, the gains are calculated on the full value, not just his down payment. By year 5, his house is worth around $304,000. By year 7, closer to $330,000 to $340,000. His equity, what he actually owns after subtracting the remaining mortgage balance, has grown to roughly $130,000 to $150,000 by year 7. That is real wealth, built partly with the bank's money. This is the one advantage stock investors genuinely cannot replicate without taking on serious margin risk. And there are tax benefits. Tyler can deduct mortgage interest, property depreciation, and maintenance costs from his taxable income. That depreciation deduction alone, the IRS letting him write off the theoretical aging of the structure, even while it's appreciating in value, is a legal tax shelter that Marcus simply doesn't have access to. So Tyler is not losing. Let me be clear. His net worth is growing, but it's growing slowly on the cash flow side, and it's costing him time, stress, and concentration risk. Everything he has is tied up in one house, on one street, in one zip code. By year 7, he's also dealt with a roof repair that ran $7,500, 2 tenant turnovers with associated vacancy and cleaning costs, a full bathroom plumbing job, $2,200, one tenant who paid late for 3 consecutive months before finally moving out. His actual cash-on-cash return, the money he pockets versus what he put in, is running about 3 to 5% after real expenses. Not terrible, but not the 15 to 20% that gets thrown around at the bigger pockets meetup. Marcus's side in the middle years. By year 7, Marcus's portfolio, with $400 monthly contributions and roughly 10% average annual returns, is sitting somewhere around $155,000 to $175,000. He didn't call a plumber. He didn't screen a tenant. He watched 2 market scares happen on his Fidelity app, one of them dropping his portfolio value by nearly 30% temporarily. And he did the hardest thing any investor ever has to do. Nothing. He just waited. And now compounding is doing something that's hard to explain until you see it on a graph. The gains on his gains are generating more new wealth each year than his monthly contributions are. He's crossed the threshold where the money is genuinely working harder than he is. Here's where it gets honest. Tyler at year 20. His house is worth somewhere between $520,000 and $570,000, assuming consistent appreciation. His 30-year mortgage is either paid off or within a few years of being done. His equity is roughly $470,000 to $520,000. He's collected rent for 20 years, but after 2 decades of maintenance, at least 2 major renovations, kitchen update, new HVAC system, multiple tenant turnovers, a stretch where he had a difficult tenant that required an eviction filing, property tax increases that tracked with the home's value, and the ongoing quiet cost of his time and energy. His net cash profit from the rent itself, above what he spent operating the property, is maybe $50,000 to $90,000 over 20 years. In a hot market, maybe more. In a flat one, maybe less. His total wealth, somewhere around $520,000 to $610,000, counting both equity and net cash flow. And he owns something physical, something he can drive past, something he can pass on to his kids. That matters to people, and I'm not going to pretend it doesn't. Marcus at year 20, with $50,000 initial, $400 monthly contributions, and roughly 10% average annual returns, his portfolio lands at approximately $490,000 to $540,000. Total money he actually deposited over 20 years, about $146,000. The other $350,000 plus, pure compounding. Money that grew from money, that grew from money. No debt, no tenants, no eviction filings, complete liquidity. He can sell any portion of his portfolio on any trading day in about 3 clicks. The scoreboard at year 20, total wealth, roughly even, both somewhere in the $500,000 to $600,000 range. But the path to get there, completely different. Tyler worked for his, late nights, property decisions, tenant relationships, repair coordination, 20 years of being someone's landlord. Marcus waited for his, with discipline, patience, and the ability to sit still during markets that wanted to scare him out. Neither of them is wrong. But neither of them is the obvious winner either. I want to be straight with you about both sides here, because most finance content picks a team and cherry picks the data. I'm not doing that. Real estate risks that get glossed over. Bad tenants are not an edge case. They are a statistical certainty over 20 years of being a landlord. In most U.S. states, a tenant who knows the eviction process can remain in your property for 3 to 6 months without paying while the court process runs its course. In some states, California, New York, Illinois, it can take even longer. That single event can erase an entire year of profit. Concentration risk is real. You are betting everything on one asset in one location. If a major employer leaves your city, if the school district deteriorates, if the neighborhood shifts, your entire investment feels every bit of it, with no diversification to cushion the blow. Liquidity risk is real, and it gets ignored constantly. If you need $30,000 urgently, you cannot sell one bedroom of your rental house. You either refinance, take out a HELOC, or sell the whole thing, slowly with a realtor commission, closing costs, and capital gains taxes waiting at the finish line. Stock market risks that get glossed over. Volatility is genuinely brutal in a way that's hard to understand until you live through it. In 2008, the S&P 500 dropped 37%. In March 2020, it fell 34% in about 5 weeks. If Marcus had $200,000 in his portfolio and watched it become $130,000 in a month, that is not a number on a screen. That is a physical sensation in your chest. And the data is clear. Most retail investors panic sell during crashes and buy back in after the recovery, locking in losses at exactly the wrong moment. There's no monthly cash flow. Index funds pay dividends, but on something like VTI, you're looking at roughly 1.5% yield. On a $200,000 portfolio, that's maybe $250 a month. That is not replacing anyone's paycheck. No leverage. Marcus used $50,000 to control $50,000 worth of assets. Tyler used $50,000 to control $250,000 worth of assets. That 5-to-1 multiplier is the single biggest reason real estate builds wealth faster in the early years and why so many American millionaires got there through property. Real estate genuinely wins when you find a property where the monthly rent is at least 0.8 to 1% of the purchase price. On a $250,000 home, that means $2,000 to $2,500 in monthly rent. That's when the cash flow math actually works from day one instead of just on a spreadsheet. You treat it like a business, not a side hustle. Proper tenant screening, capital expenditure reserves, documented systems. The landlords who struggle treat it casually. The ones who build real wealth treat it like a second job they actually manage. You use house hacking. Buy a duplex or triplex. Live in one unit, rent the others. Your tenants cover your mortgage. Your housing cost drops to near zero while you build equity. That is something a brokerage account simply cannot do for you. You use 1031 exchanges, rolling profits from one property into the next without triggering capital gains taxes immediately. Over 20 to 30 years, that tax deferral compounds into something significant. Stocks genuinely win when you are consistent and you do not panic sell. That is the whole game. Investors who stayed in through 2008, through 2020, through every scary headline, they came out on the other side with portfolios that rewarded their patience enormously. You increase contributions as your income grows. Going from $400 a month to $800 a month in contributions doesn't double your 20-year outcome. Because of compounding, it can come close to tripling it. You honestly value your time. If managing a physical asset and being responsible for the humans living inside it is not something you want in your life, that stress has a real dollar cost that never shows up in any rental property analysis. Here's what I actually think after running all of this. The question was never really real estate or stocks. The real question is, what kind of investor are you actually going to be? Are you someone who will hold through a 35% market crash without selling? Not theoretically, actually. Because if the answer is no, if you're going to sell at the bottom and buy back in after the recovery, you will underperform both real estate and the market average. And all the YouTube videos in the world won't save you. Are you someone who will treat a rental property as a genuine business, running the real numbers before you buy, maintaining the asset properly, screening tenants carefully, setting aside money every month for the roof that will eventually need replacing? Because if the answer is no, if you're going to treat it like passive income that magically deposits itself, You are going to spend 20 years wondering where all the money went. Most people arguing about real estate versus stocks are actually arguing about two different versions of themselves: the disciplined version, who does it right, and the version they're actually likely to be on a random Wednesday night when something goes wrong and the easy choice is right in front of them. Tyler and Marcus both ended up in good shape at year 20, not because of what they picked, because of how they committed to what they picked. The asset class was almost secondary. And that part, the commitment, the staying in when everything in you wants out, the boring consistency over 20 years when nothing exciting is happening, nobody can give you that. Not a real estate agent, not a fund manager, not a finance video.